Welcome to another Taking Stock episode for the week ending the 10th of October 2025. I'm Kien, Head of Research at Stock Doctor, and joining me today is our equities analyst, Charlie Song, to stream to your Think Share Market. Welcome aboard, Charlie. Great to have you on board.
Yeah, great to be here, Ken.
Yeah, and with AGM season now here, there's always something happening in the market. But as always, the information we share today is of a generic nature and doesn't take into account your personal situation or needs. Shares are volatile, so past performance isn't indicative of future performance. Well, it's been another resilient week for global markets, with both the US and Australian markets extending their upward trend. Investor sentiment continues to be supported by expectations that central banks will continue cutting interest rates this year, helping to ease financial conditions and support global growth.
Yeah, and at the same time, confidence in the global economy improved following comments from the International Monetary Fund, which said the world has held up better than expected despite multiple shocks in recent years. The IMF expects global growth to remain near 3% over the next 2 years.
Also, the biggest headline this week came from the gold market. The precious metal went through 4,000 US an ounce for the first time ever, driven by a combination of central bank buying, ongoing geopolitical tensions, a multi-month decline in the US dollar, and a renewed safe haven demand. Investors are clearly looking for stability as inflation pressures linger, and this theme continues to benefit our overweight exposure in the gold sector across our star growth stocks.
Yeah, investors are calling it the great debasement trade.
Mm.
Elsewhere, copper prices continue to rise on supply concerns flared following accidents at major mines in Chile and Indonesia. The red metal is a beneficiary from long-term demand linked to electrification and renewable energy projects, where copper plays a key role in transmission and storage infrastructure. Our star growth stocks, Sandfire Resources and AIC Mines, have done especially well after we initiated coverage last month.
Yeah, and let's not forget, though, outside of the pure copper plays, investors can also gain exposure to copper via BHP, Rio Tinto, Evolution, and Newmont, which do have some copper exposure. But speaking about resources, let's turn our attention to gold producer Catalyst Metals, a mid-tier Australian gold producer operating in Western Australia's plutonic gold belt. The company released its September quarter production update, which was about 10% below guidance.
This did lead to a negative share reaction, and the shortfall was mainly due to lower availability of crushing equipment as the company upgraded its processing circuit and installed new mill liners. Importantly, those works are now complete, and management has confirmed that full year guidance remains unchanged at 100 to 110,000 ounces of gold, with an all-in sustaining cost between 2,200 and 2,650 per ounce.
Yeah, and despite that lower production, this does imply stable production and growth rates from the previous year. But looking ahead, though, return on invested capital is forecast to rise to around 72%, very high there, while recent earnings revisions have also eased by about 4%. And that seems to be driven by that capital raise a few months earlier to fund its growth strategy. Development of new mines at Trident, K2, and also Old Highway continues to track well, supporting growth towards its medium production target of around 200,000 ounces per year, nearly double current rates.
Moving from resources to financials, let's talk about star growth stock Netwealth, one of Australia's leading wealth platform providers. The company reported a strong first quarter update, which you wrote about, Kien,
Mm.
and with net flows of $4.1 billion, up 8% on the prior quarter. That was driven by broad-based advisor transitions and new client growth across both its custodial and non-custodial segments.
Yeah, very steady growth there, Charlie. And management did reaffirm guidance for financial year 26 net flows to be broadly in line with last year and for operating expense growth to remain steady. And the business is benefiting from significantly higher managed account flows, which has higher margins. And this should contribute to another year of double-digit earnings growth. And looking ahead, though, return on equity is expected to moderate from 68% to around 63%. And This small decline reflects the impact of tiered fee structures that reduce margins on larger client balances, along with ongoing investment in technology and also new product development to support that long-term scalability.
Yeah, I mean, profitability of this company remains exceptionally high, and there is pretty strong recurring revenues here, with operating leverage also at play as that platform scale continues to increase. That's probably why it trades at a forward price to earnings multiple of 56 times. That sounds scary, but some of that premium does seem justified given Netwealth's the visibility of its growth, both in the short and long term, and the high quality of its earnings.
And looking at the share price value, it does trade at a slight discount to that fair value among consensus analysts. And with the recent share price decline, that could represent opportunity for long-term investors. It's also worth noting that Netwealth remains founder-led, with Michael and Matt Hain controlling nearly half the company through their family trusts.
Looking at the corporate calendar for the week ahead, the bank reporting season, as you said, kicks off with the Bank of Queensland expected to release its results. Also on the radar is an AGM, annual general meeting from Telstra, and a quarterly update from CBA.
In Under the Microscope this week, we're revisiting James Hardie, the building materials company that had a rocky year, but managed to surprise investors with a strong second quarter trading update this week, leading to a share price jump.
Its quarterly sales were roughly 9% ahead of expectations and earnings about 16% higher than forecast. Customers such as retailers and distributors are destocking and beginning to buy building products at a steadier, more normal pace again.
Well, Charlie, that's a welcome sign after several soft quarters in the US housing market. And the company, remember, they newly acquired AZEK, that decking company and railing business, but that acquisition appears to be holding better than expected, posting mid-single digit growth despite a tough construction environment.
Yeah, and there were some major concerns about that acquisition, weren't there, Kien? But
Mm.
while the update was positive, it doesn't change our view. In fact, the unexpected update reflects our previous concerns about lack of earnings visibility from management. If you can recall, we removed James Hardie from coverage earlier this year after that 14 billion US dollar acquisition of AZEK. The deal was huge, about half the company's market value. It was also expensive in our view, and it was completed without a shareholder vote due to the way it was structured, raising major governance and execution concerns.
Yeah, that's right. And those risks are now showing up in the numbers. Return on equity is expected to fall sharply from 32% to around 11% this year due to that higher debt and also dilution, integration costs, and weaker profit margins. Analysts have also cut earnings forecasts by more than 30% over the past few months as confidence in the growth story fades.
So while the business is trading at a slight discount to fair value, big challenges remain. The housing cycle is still weak in America, and debt is high, and investor trust has been badly damaged. CEO Aaron Erter and the board are under increasing pressure ahead of the annual meeting later this month, with major shareholders in Australia calling for a board shakeup.
Yeah, quite a few issues there, Charlie, until management actually restore transparency and also strengthen the balance sheet and profitability. From our perspective, the risks continue to outweigh the rewards. And now for question of the week. It comes from several members who've asked, with copper prices hitting fresh highs, how can investors identify profitable copper stocks on the ASX?
Yeah, and that's a great question. As always, the best place is to start with our Star Growth Stocks list. Two standouts that we have that are exposed to copper are Sandfire Resources, SFR, Australia's leading pure play copper producer, and a smaller but growing AIC Mines, A1M is the ticker there. Both are well managed and leveraged to the global electrification theme.
Yeah, and if you like to explore other copper opportunities, you can use the stock filter tool within Stock Doctor. Simply select metals and mining under the GICS classification, then type copper in the business description field. From there, Add key filters if you want to, like financial health, return on invested capital, earnings quality, and perhaps average daily traded volume, just to narrow down on the strongest candidates. They'll give you a list of financially sound copper exposed stocks.
Yeah, and you can save that list as a watch list or export it as a CSV file for further tracking. A great way to stay across that sector.
And remember, the same process works if you're looking for other electrification metals such as lithium, nickel, or cobalt. With demand for these materials set to rise over the coming decade, it's a quick way to identify the company's best position to benefit. But that's all we have time for today. Thanks, Charlie, for joining me.
Yeah, and as always, feel free to join us for Lincoln Live next Monday if you have any further questions from today's episode.
And before we wrap up, just a quick reminder, if you do have friends or family who could benefit from Stock Doctor, feel free to share our link with them. Our growth comes from members like you, and we truly appreciate your ongoing support. Until next time, take care and have a happy, healthy, and prosperous week ahead.